Instant paychecks and no more waiting. Let's talk about FedNow. Well, right now.
In your bank account, the Federal Reserve announcing it has gone live with its new FEDNOW instant payment system, a system that should allow households and businesses to send payments and receive money immediately without those troubling 3-day holds on checks and waiting for payments to clear in the sender's account and waiting for the bank to open on Monday or after a holiday. The FEDNOW system is an instant payment system. It's available 24/7, 365 days a year. To begin with, 35 banks and 16 service providers have already signed up. Those banks include things like JP Morgan and Wells Fargo, as well as smaller credit unions and other banks. Unclear if the banks are going to charge for this instant payment. They are charged, but they may or may not pass that along to consumers. Fed Chair Jay Powell saying in a press release, over time, as more banks choose to use this tool, the benefits to individuals and businesses will include enabling a person to immediately receive a paycheck or a company to instantly access funds when an invoice is paid.
Sure, they talk about all the advantages, but the FedNow launch also comes with some pretty big challenges for banks and other payment players. Moody's did a whole report about this. Loss of interchange revenues, issuers rely heavily on fees from credit card payments and, to a lesser extent, debit card payments. But if consumers and businesses start using FedNow instead of cards, those revenues could very well dry up. In 2022, merchants paid an estimated $85.6 billion in credit card processing fees, and more than 80% of this went to issuers as interchange revenues. But with the introduction of the FedNow system, there is a possibility that consumers and businesses might shift away from using credit cards and instead opt for instant payments through this new real-time payment system. Now, since FedNow offers the convenience of instantaneous transactions without the need for intermediaries like credit card networks, some issuers actually could prefer this method over credit cards. This could affect banks, Visa, MasterCard, American Express, you name it, especially for everyday transactions. Now, if a big enough number of consumers and businesses switch to using the FedNow service platform, it could potentially lead to a decline in credit card usage. And as a result, the volume of credit card transactions would also decrease, leading to a reduction in interchange fees collected by credit card issuers. In other words, the revenue generated from credit card payments would dry up for credit card companies. Then there are the costs of beefing up the tech, right? So FedNow enables 24/7 real-time money movement, but this adds security risks to FedNow partners. They won't tell you this, but the Fed could also monitor your transactions in real time and also disrupt them if needed. You know what I mean? They may need to increase investments in technology and staff to monitor around-the-clock transactions to protect against cyber attacks. Now, one of the primary challenges that financial institutions face is the constant monitoring required for real-time transactions. It's not like traditional systems where transactions may have been basically batch processed or settled at interval periods. The instantaneous nature of the FedNow transactions means always on, never off continuous monitoring. Now, they basically need this real-time monitoring for identifying and responding to any potential security threats promptly. But that puts smaller banks at a disadvantage since they don't exactly have whole cybersecurity departments dedicated to this type of thing. You know what I mean? Plus, there's always the looming threat of bank runs. Faster money movement could also increase the risk of bank runs. Moody's noted that recent bank failures were exacerbated by the speed of withdrawals, which could happen even faster with FedNow. Bank runs happen when a large number of customers simultaneously withdraw their deposits from a bank because they feel that the bank could become insolvent or basically fail to meet its obligations. And so what this means is that banks' reserves definitely won't be able to keep up. So you'll end up with a full-blown collapse like what we saw with Silicon Valley Bank. And now the speed of transactions with FedNow introduces an element of immediacy to money movement. Since customers gain that immediate access to their funds through real-time payments, the possibility of withdrawing huge amounts of money from their accounts becomes even easier and quicker. This newfound convenience could potentially stoke people's fears and panic that could trigger a bank run. Now, just as an example, just imagine a scenario where rumors or negative news about a bank's financial stability spread ultra fast on social media or news platforms. In a traditional system, customers could basically take some time to consider their options systems and maybe coordinate their actions. But with FedNow, customers could quickly and simultaneously withdraw their funds, so that could mean a rapid drain on the bank's resources. The risk of faster bank runs could have pretty big consequences for the stability of financial institutions, especially smaller banks with fewer resources to weather these kinds of threats. We're talking sudden and sharp withdrawals of deposits that could seriously drain a bank's liquidity, making it basically, very difficult for them to meet their customer demands and maintain normal operations. The potential end result, a loss of confidence among other customers, and possibly triggering a domino effect on the broader financial system. Maybe FedNow should have a requirement that any banks using the system need to dramatically increase their capital reserves to lower the chances of bank runs making banks insolvent. But what do you guys think? Now, I'm pretty sure we've all wondered why businesses can charge my card before I get to my car, right? But yet, it takes weeks to get a refund. Don't forget to subscribe to the channel, you guys. And by subscribing to the channel, you guys will stay up to date with all the latest updates in financial topics, news, and strategies for achieving financial freedom. So make sure you guys are subscribed to the channel. You guys' support means the world to me. And it also helps the channel to continue to create informative content for you guys. So make sure you hit the like button, hit the subscribe button, and join our financial freedom fam. Now, another one that I read about FedNow, instant payments or instant fraud. FedNow's faster payment capabilities, there's this newfound convenience, but it also makes smaller institutions so that fraud could be more susceptible. And apparently fraudsters tend to target smaller and medium-sized entities because they lack the extensive resources of the large banks. These criminals see a huge opportunity and they exploit it. But wait, there is more. So once fraudsters identify a successful method, they apply it not only to other institutions of the same size, but also to big banks. It's kind of like a domino effect, making the fight against fraud even more challenging. Cases of authorized push payments, or APP, fraud and scams have surged by 12.5% between 2021 and 2022. APP fraud alone has nearly tripled, accounting for a staggering 18.6% of all fraud worldwide. For now, the US has managed to avoid the full impact of APP scams since it's only 1.2% of real-time payment transactions. But if the Fed doesn't do anything about this, the US could eventually face a similar crisis level of APP scams seen in other markets. Now, what's especially worrying is that despite the growing levels of fraud, FedNow does not currently have specific plans to incorporate fraud detection technology. So basically, financial institutions are left to fend for themselves in detecting and combating real-time fraud. Most likely, we're going to be seeing solutions that are reactive rather than being proactive. We'll just have to see how this turns out, but it's kind of scary how a big potential problem that this could actually be. By the way, if you guys own a home, make sure your home is protected. Get your free home warranty quote. There's a link in the description down below this video. And you know what, guys? If you lose your money due to bank fraud, they're not legally obliged to give you your money back. Now, I remember that one story of a JP Chase client losing $30,000 because the bank gave somebody else with a fake ID access to the account. How did JP Chase respond? Basically, tough luck. Now, just imagine this happening on a massive scale with FedNow. Definitely concerning. Now, if you fall victim to fraud or unauthorized transactions, getting a reversal or reimbursement might not be as straightforward as it is with traditional systems. You see, once the money is sent through FedNow, it's kind of like a wire transfer once it's done. The Consumer Financial Protection Bureau is looking into this matter, but we're not sure yet how this is going to play out. And if you know anything about wire transfers, good luck on getting it back if it was sent in the wrong direction. Now, FedNow, it's not exactly a CBDC, but it still contains a lot of dangers. Now, you may have noticed FedNow has been a trending topic on Twitter. A lot of curiosity, a lot of skepticism, and well-founded concerns about privacy and government surveillance. And so this is where we need to be clear. FedNow, it's not a central bank digital currency or a CBDC by itself. Nonetheless, since its approval by the Federal Reserve in 2019, I have consistently warned about the potential dangers that it carries, pretty much like with a CBDC, and the unique risks with the unprecedented intrusion of the Federal Reserve into everyday economy. Now, in essence, FedNow is a government-backed real-time payment system designed to compete with private sector alternatives. And it will directly challenge existing bank-based payment systems like RTP and Zelle, and indirectly compete with popular fintech apps like Chime and Dave, along with privately issued cryptocurrencies. But some experts in the field, they're saying that FEDNOW appears to be a solution searching for a problem, potentially leading to the creation of new issues. Now, the major concern shared with CBDCs is that FEDNOW would allow the government, specifically the Federal Reserve, access to sensitive details of consumer transactions, posing significant privacy risks. And so this means the government could obtain your personal data without a warrant and potentially share it with law enforcement agencies. Plus, how susceptible could this be to hacking? And you know the government's track record with data breaches, it's not really any better than the private sector's. Not to mention, just think about the ethical questions, including the revelation of intimate spending habits, travel history, and more, which, by the way, the government should not have the right to know. But what do you think, guys? And like I mentioned, the competition. The rollout of FEDNOW raises concerns about its potential to crowd out private sector competition from fintech and from cryptocurrency providers because, let's face it, guys, it's pretty hard to compete with government backing combined with the regulatory wielding power of the Federal Reserve. This could stifle innovation and limit consumer choices in the payment space. In fact, FedNow could very well be putting banks in the front of yet more risks because of all these faster payments. I mean, sure, there's flexibility, there's also danger here though. Experts even went as far as to suggest that the payment service may end up being like credit negative for banks, particularly the smaller banks. FedNow is also set to revolutionize bank-to-bank payments, allowing money transfers in near real time at any time of the day as per the Federal Reserve. Now, they're saying that the implementation of this system could benefit smaller banks and credit unions, enabling them to catch up with larger competitors and non-banking institutions in terms of payment technology, enhancing their competitiveness, especially among younger consumers. But what they don't really talk about is how FedNow's introduction could also have a negative impact for payment firms and banks that heavily rely on debit and credit card interchange fees, potentially reducing their revenues. Now, the major concern for banks is the risk of losing out on the float, like the funds that they effectively earn before, formally registering a deposit or withdrawal. Now, with instant payments, consumers can quickly move their funds, so there could be this reduced deposit balances. Plus, banks might need to invest heavily in upgrading their infrastructure to support the technology, which is a whole other mess of costs if you guys think about it. And FedNow means money has to be available for people 24/7. And so that could pose liquidity management challenges for smaller banks, especially during periods outside of regular work hours. I mean, just ask SVB, Silicon Valley Bank. These recent bank failures have they've highlighted the major role of how fast deposits can move in and how quickly bank runs can happen. Though they have launched already, FedNow's widespread adoption and significant changes to payment methods, they could take a decade or more. And that is because in economies like ours, with well-established payment infrastructure, services like this take a while to see bigger adoption. I mean, really? Instant payments take off quicker in emerging markets. In the United States, FedNow will not only compete with traditional payment technologies like credit cards and automated clearinghouse transfers, but it's also going to be directly challenging the real-time payment network, which is owned by major banks. Plus, the banks face another risk with the rise of Apple Inc.'s savings account, which offers high yields and enjoys strong consumer trust. Overall, FedNow is promising to transform payment systems, but we really haven't seen its full impact on the banking industry and payment landscape quite yet. Right now, it's more about the cautious optimism in the industry, kind of like a wait and see for further developments. Something that we're going to have to keep an eye on in our next updates, right, guys?